So with that, should we jump into some of this content and parlay it back to what we've been talking about in terms of relationships?
Yeah, absolutely. Let's understand better the flow of money, how we save, how banks lend, and the true, cost to us and the true benefit to the bank.
Okay, perfect. So we're going to talk about flow of money, and we're going to obviously make a very simplistic set of diagrams here for the purpose of driving an idea. We're not talking about specific examples. Numbers do not matter. What matters is the concept that we're trying to discuss. So I'll walk through this, and then we'll both discuss here as we go. So in a normal economy, the commodity we're talking about is money, right? We're talking about the thing that we're transacting with is money. Money is very important because it's a way in which we store energy. Our previous productivity has saved, if we have savings, is going to leave us some capital that we can deploy later, or we can store and save and grow, right? Money is a way to concentrate the energy we've spent, the time we've spent, and also for future, right? So in that transaction, number one, money is usually always 50% of any transaction, if you think about it. You're going to buy a car, 50% of the transaction is me giving you money and you giving me the car. That applies for most things unless you're in a bartering system, which I would bet for most of us in the United States, we don't necessarily operate like that. So number one is very necessary. We're going to encounter in everything. Mm-hmm. And number two, there's usually three roles, three ways to interact with that, okay? The first one is the saver. So who are the savers? Anyone watching this content right now. The consumers, people that buy groceries, people that buy gas, the business owner that's paying payroll, right? And the investor that needs that capital, the difference between what's earning and what's spent for them to have a pool of liquidity that they can go and deploy, right? And therefore, that's going to be any of us, right? We are the savers. And what do we do with that saved money? What do we do with that saved capital? We have to warehouse it. We have to store it somewhere, right? Most of us will call that person, in this case, most cases, an entity, the bank, the banker, right? So in exchange for safety, easy of access, for convenience, we are going to find an entity that's in any corner with the best real estate in the city, right? And we're going to put it there, that has an electronic app, that has an ATM, we're going to put it in the bank. And in exchange, they're going to pay you some type of interest, usually quite low if you talk about savings accounts, checking accounts, CDs, blah, 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 right? That's how the saver interfaces with this exchange of money. They are going to create some capital that they're going to take and warehouse it somewhere, usually an entity like a bank. On the opposite side, for the banker to be able to pay us that interest, he needs to send that money somewhere else. Usually they need to give it to a borrower in the form of a loan. Mm-hmm. And who are the borrowers in a normal economy? In our economy in the United States? Consumers, the person that borrows to purchase a house or a car, the business owner that needs a credit line to go and pay for their capital expenditures or buy a new machine, the investor that is using leverage to buy futures, right? And guess what? The bank, for the use of their money, obviously the borrowers are us again, the bank is going to charge an interest rate. This interest rate will be higher than this interest rate that they're going to pay us, and their business is completely supported on keeping that difference. Correct. Anything to add?
What this is called is arbitrage. So they're getting money, they're charging more for the money, and they're getting the money back. So they're making money off of our savings, off of taking our savings, leveraging it to give loans, and we will have an episode truly on how the bank functions. Yeah. So we won't get deep in the weeds that way today. But in short, the bank is marking up their cost of money in order to make more money.
Yeah, and like we said, right now we're painting the outline of the monster in the closet, right? We're trying to identify. This is a very simple idea, but if you've never stopped to contemplate the fact that you are the person that every Friday sends your paycheck to a bank, and you are the same person that has a credit card with that bank, but some third entity is creating arbitrage between those two things, it doesn't seem that simple until you visualize it. Right. And the question that this begs is, who the heck is the banker? And why do I keep funding that business when I'm the person putting the capital and the savings and then paying the interest when I borrow money, right?
Right.
So if we think in those terms, the question that comes up is, hey, what would happen if this good-looking guys or yourself get also imposed in the middle and you close the loop and you start creating your own economy? And you are the person that is capable of warehousing an amount of capital that you've saved from your productivity that can have access to it to leverage and go and create more cash flow and create a loop where all this interest stays within you, your family, your business. There's power on this idea. But until you recognize that this third place, this third role in that economy is not being played by you, and that you already engaged in that, whether you like it or not, whether you know it or not, it can only push in one direction. And it's, I need to learn, I need to educate myself more about how can this be possible for me and my business.
How can I be the bank?
Yes. So this, to me, this understanding is one of the major issues and one of the biggest opportunities we need to go and create conscience on, go and make people aware about, because it is a very powerful combination of the things that you are doing and just need an enhancement by you taking that role, taking that responsibility with the right mindset, the right education, the right process, and the right products.
Absolutely.
Right? Okay.
Yeah, let's talk a little bit more about how we use money and the true cost of money. So in this example, let's say that we need to buy a car. So we go to the bank, we go to the credit union, and we say, hey, I need a $20,000 loan. I need to buy a new car so I can get to work. The bank says, okay, here's your $20,000, and we end up making payments. So, we borrow down to this amount here. We get a 5-6 year loan for that car, keep chunking away those payments, and then eventually we pay that off. And then it's time to trade in the car because it starts having issues. And so we repeat this process, and this is what it looks like. We got these little windows where we're not making payments. Finally feel like we're getting ahead a little bit, and then that check engine light comes on, or new tires are needed, or something like that, and we end up repeating this cycle. So in this example, our cash flow is tied up going to the bank, paying this interest on these loans in order to just get to work, in order to add another vehicle to our fleet. And we borrow this money, have to pay it back, borrow more, pay it back, in order to just try to get ahead. And in reality, it's taking a whole lot of effort just to maintain status quo, let alone get ahead. And then the flip side of the coin here is if we pay for cash.
Okay, let me add one thing to what you just said, which I think is really powerful. This is probably the most accessible idea to most of us because we've all heard, hey, debt is bad, right? Why? Number one, the obvious reason when you incur debt, you're going to be paying interest to a separate entity, to a bank, to whoever financed this. Most people don't enjoy paying interest, obviously. The second part of this, and I think this applies to a lot of business owners, is you're going to be subject to the terms of that debt that somebody else is setting for your business. So payroll, capital expenditures, all those things will be subject to somebody else setting the payment, the schedule, the balloon payment at the end, whatever it is.
Right.
And that affects how you run your business because it affects how you control cash flow. It affects how you think about reserves. So it has a lot of negative connotations when you are depending on a credit line or when you're depending on debt. More importantly, I want you to pay attention to this. If you zoom out through the whole cycle of the lifetime of a person, of a family, a business, it's not just those two things. It's the fact that money, number one, is always flowing away from you and your family. You'll incur that debt and your future productivity will make payments to drive that debt back to zero. And a period later, when you need to access that credit line again, you'll continue that cycle and money's always flowing down out of your family to that third party entity.
Right, you're borrowing from your future.
Exactly. And then the second thing that I think is also quite telling and most people have never noticed is that this is an equation, this is a behavior, this is a process that always tends to zero. Always tends to zero. If you do this, doesn't matter the magnitude of the debt you incur. Could be $100,000, $1 million. You're always paying to go back to zero. So you're never creating capital accumulation for your family and business. So
Right.
let's jump into the opposite case that you were mentioning, which is cash.
The opposite being cash. So with cash, it's just the inverse. We're saving up for a period of time. So put money away for several years until we can finally make that big purchase, buy that vehicle, buy that, pontoon boat, whatever we want for our family. Or, we're starting a business and we're finally able to buy all of the new equipment for our restaurant, something like that. So we're saving. But then once we spend that money, it's gone.
Yeah.
Like we have the things, but we've given up the opportunity for that money to keep multiplying.
Yeah.
Now it's going to work in the way of if we're putting this money in our business is able to be productive, so we're able to earn more money. However, that dollar we spent, we can't get any more interest on that. We can't reinvest it again because that's been spent to acquire a thing. So very similar type setup of, you're saving up, you're spending, you do have the equity in whatever it is that you're buying, but most things that we buy with cash depreciate. They have a useful period before they're gone, and we've essentially lost we've lost on the potential for that dollar to keep making more dollars.
Absolutely, and I just want to extract a couple of things you said there because they're really powerful. Notice how Josh was talking about, yes, you do have the equity of whatever asset or liability you purchase, right? But note that the title here says cash flow, and we have a particular focus on the word cash flow because we understand that flow of money is the way we interact with the financial system, the way we buy the things we want, the way we invest in the assets we want when there's opportunity, the way we respond to emergency. Prioritizing cash flow is going to be one of the key items, one of the key ideas that we are going to continually talk about as we continue the episodes for this show. The second thing I want to extract from what you said is, hey, you know what? When you save, it is a better behavior than the debtor. Number one, because you're delaying that experience of the purchase or the investment. Right? You have to have discipline to do the accumulation of that capital over time.
Right.
So you are understanding that time is valuable, that your potential productivity is valuable. You want to store some of that energy. But when you get to that purchase point, and it's going to come because emergencies and opportunities will come to your life, you're going to draw that bank to zero. You're going to use that savings. And the price of using that savings is that you're going to interrupt the compounding of your money. And that is a very expensive thing to do, particularly because it's not just this amount of capital you had accumulated. But like Josh said, and these words are very important, the interest that amount of capital could have accumulated for the rest of your life. That's the part that's expensive. That's the part that's expensive because there's a long time here that this money could accumulate, and compounding is very powerful. Over time, that's an exponential function that is going to be a lot greater than this amount of capital you use there.
Right. They both have their pros and cons.
Yep.
Financing, you get the money now, you're able to start making hopefully more money than that money costs you.
Yep.
Cash, you're putting off the potential to make money. You're probably earning some interest in a high yield savings account, CDs, things like that.
Yeah.
However, again, once you spend that, it's gone. So, no matter what, we're not truly getting ahead.
Yeah. And, this is an illustration we use to explain to people, okay, let's get to the core of what the understanding is of the problem. What is the problem you're dealing with in finance that we need to find a solution for? This is not unique to you or me or people in the middle class. This is something that has impact businesses. Businesses, before discovering something called economic value added, would get on a board, and instead of deciding to use debt, would use their own capital until somebody, probably in that board, or some economists talked about this and said, hey, instead of using your capital, could you not use your capital to go and buy a corporate bond and earn more interest that you're going to earn on the project you're going to invest? Isn't there an opportunity cost for that? And are you not giving interest up? So that realization leads to this conclusion. Everything you purchase, you're financing because either you're paying interest to somebody or you're giving up the opportunity to earn interest, right?
Correct.
And that is the opportunity cost of financing, which is the problem why families are not moving financially forward in growing because they're dealing with this. what is the difference between being so passionate about saying, oh no, I'm not going to use debt, I'm only going to use cash, or the reverse? These two things are the opposite sides of the same coin because they all lead to zero. This is the conundrum, the financial problem we're dealing with when people don't get a closer relationship with money and understand that they need to engage in a way that they understand, and then they need to put processes that take away the bad or not bad things, the costs of either of these processes, and actually leverages the good things of it, the compounding and the opportunity to use somebody else's money.
Absolutely.
Right?
And the leverage is key there. So
Yes.
how do we use cash? How do we use debt? Or is there another option that provides more leverage, more earning potential?
Yeah. So we had summarized here some of the insights that we just mentioned. I think we've summarized this, but just to reiterate, have it in writing for everyone to see. Hey, the problem is you're financing everything in life. You're financing everything in life. And get this in your mind. The decision to purchase something is different than the decision of how to finance it. You can go after a new vehicle, and you can lease that vehicle. You can get a loan for that vehicle. You can pay cash for that vehicle. You can borrow against an asset for that vehicle, right? Those 4 or 5 things, depending on what asset you're using, are 5 independent, different ways to finance the same purchase.
Right.
And as you advance in your journey, understanding your relationship with money, you'll see that there's trade-offs for all of them, and one of them will be better suited for you, right?
Agreed.
The other thing that we've talked about is when you borrow, because you are using somebody else's money that had the discipline to accumulate capital, it's only fair that you have to pay them interest as a reward for allowing you to use that money. That's one of the roles that we talked about earlier, the debtor plays in the economy when transacting with a commodity like money. On the opposite side is using cash. And for the ability to use your own cash, you had the discipline to accumulate capital, but if you give it up to somebody else, you send that money away, what happens is that you're having a cost incur in that capital because you will not be able to earn interest that you could have in that money.
Right.
And those two things, again, are opposite sides of the same coin. The most important part now comes into play, which is the problem is that other banking organizations, and the key is other, right? That role in the middle, the banker, an institution, a private lender, whoever it is for you, finances all these items. And they're creating arbitrage between the interest they pay to the capital, the people that provide the capital they use, and the interest you're paying when you're borrowing it.
Yes, sir.
Perfect. Let's talk about an ideal case. Why do we have this diagram here, Josh?
Well, this diagram would be if we didn't give up the earning potential of those dollars. So if the green line is essentially cash. So if we're saving up, we're able to leverage that cash, but not give up the earning potential. So that is the curve here, is that cash is still accruing interest over time, even though we've essentially borrowed against it in this instance because the red line is debt. So we've used that cash, somehow borrowed against that cash value, but over time, because we're paying down that principal balance, the debt is getting smaller, but those dollars that we borrowed against are still climbing. They're still accruing interest, still compounding. So that would be the ideal scenario, is some kind of investment or savings vehicle that we could use that is going to keep compounding despite us leveraging it.
Yeah, absolutely. So just to reiterate and add to what you're saying, when we imagine, okay, is there a third possibility? Is there here an addendum to this conundrum of these two, cash and credit? What if we take the best parts of those two things and combine them in an ideal world? I can already tell you banks, corporations, the wealthy do this. This is not something that is not accessible to any of us. It's just that we don't know about it. We don't understand it. But the idea here is, what if your capital never interrupted its compounding process? Could you have a bucket of money grown in a corner of a room and you never interrupt it for the rest of your life, so that compounding gets stronger and stronger and stronger over time? That would be ideal. That would be perfect.
Absolutely.
And the second part of it, which is leverage. Hey, what if instead of touching that money, we leave it alone for compounding, but because that money is always growing in value, we get to create collateral with that money, meaning we get to create an asset that we can borrow against from somebody else's money, and we use that as leverage to take on debt, to finance the things we want to purchase, pay interest, and then repay that interest. When we repay that interest and that principal, we'll be at a higher valuation of that capital, which means we never gave up the ability to compound. If we do this over time, notice here that every time you borrow money, sure, we're paying interest, we're using that capital, but our money is never interrupted. So every time we access that money, when we repay it, the point of break even again will be at a higher point. And that is a powerful process if you think that this is how you're going to treat every vacation, every purchase for your home, every car purchase, the weddings of your children's, right? And then your investments, all the cash flow and properties that you want to buy, or whatever it is that you want to invest, including your own business.
Right.
It's going to be a powerful function that is going to yield amazing results. This is why the wealthy understand that managing money using this process is so powerful.
And in essence, this is what the bank does.
Yeah.
Because they're not truly giving up their earning potential on money. The way fractional banking works is I give them $1 and they could lend 10. So in that same instance, this is exactly how a bank would operate. And what if we could become the bank?
Which is all along the proposition we've made. Changing the relationship with money so we can understand the roles we play in that economy when we transact with money.
Right.
And for whatever reason, the roles that we're not capturing potential from, what if we step in and just learn how to also fulfill that role in our own personal economies for our business and our families? So I have one more chart here, Josh, and I think that this one is important. I want you to walk through this thought. But we've talked independently about small time frames, right, where you're going to purchase something with debt or credit, or if you had an ideal process. But let's zoom in even more. Let's go to 30,000 feet. Like, over the lifetime of a person, what is it that we're conditioned to think about how money flows through our life, and what would be ideal instead?
Well, what we're essentially taught is put money in a 401k, keep building up that nest egg until it's so many millions of dollars. That if we only withdraw 4% of that a year, that'll sustain us through retirement. And that's why on these charts it has age 65. That's typically when people try to retire. However, what we see here is one, this would be an example of a stock portfolio, a 401k. This one, it looks like it's probably invested in high risk environment because it has these huge swings. And if we looked at the stock market over time, we would see, you've got a couple great years and then a couple bad years, and there's this big swing, and it says, well, this year we're up 20%, last year we're down 20%. But what we fail to realize with all those percentages is that's from one year to the next. That's not truly how your balance is performing. Because if I started with $100 and it went up 10%, so now I have 110, and then it goes down 20%, so then I lose $22, so I'm down to $88.
Yeah.
And then it goes up 10% again, so I just gained another $8.80. Then I'm at a balance of $96.80. But if I were to average that out, it would be a loss of 1%.
The fallacy of average of returns.
Correct. So I ended up with $96.80, but if I truly had a net loss of 1%, I'd be at $99.
Yeah.
So that's something that, when we look at the stock market and it's talking about these averages, it's not talking about the true impact that that's having to your portfolio.
Right.
And so that's the hard part for me about supporting an IRA or a 401k, especially if it's not self-directed, is that we send this money away from us. We're not in control. We give it to our employer's broker that does these 401ks, and we're just told, build up that nest egg, build up that nest egg. However, we have all this uncertainty. I've had multiple clients that have thrown money at the stock market, and they're like calling me up and earlier this year saying, I've lost 20%. I had, $1.5 million and I've lost 20%. I'm not going to be able to retire. I need to go back to work again. And that's such an unsettling thing, going or approaching retirement in that way, as opposed to focusing on controlling that money dictating where it goes, getting educated, and then building up cash flow. So in the second chart here, this would be more indicative of buying several rental properties. So if you enter the workforce in your mid-20s and you're putting the $16,000 or $17,000 you can contribute toward your 401k, instead of doing that, if you put it toward saving up to make some rental property purchases on a 30-year mortgage. So if you started at age 25, over here, by age 55, just making regular payments on that 30-year mortgage, you'd have a property paid off at age 55. Well, now your cash flow just probably tripled or quadrupled based on that payment. And if you're able to buy one of those every 3 to 5 years, as opposed to sending that money into your retirement account, one, you're able to control that real estate portfolio. You're able to change the condition of the property. You're able to pick your own tenants. You're able to improve the property or not improve it. And thus you have control. If something happened, you could sell that property and redirect that money and not pay a penalty of 10% to touch the funds that you can't touch until you're of retirement age in a 401k. So this would be focusing on cash flow as opposed to building up just a nest egg. So over time, that cash flow keeps growing. You got $400 a month from a rental. You buy another one. Now you've got $800. You buy another one. Now you've got $1,200. And once those are paid off, that's probably closer to $5,000 a month, not adjusting for inflation, rental increases, things like that. So if we focus on what kind of cash flow will we need in retirement to sustain our ideal life, that is a much different equation as opposed to accumulate and don't touch and let somebody else control it.
Yeah. Let me add a couple things and extract some of the things you're talking about there. You guys probably can hear this conversation, and obviously, your core competency, your expertise is in real estate and seeking cash flow that way. So obviously, that's a point of view Josh has. This is independent of the asset class. It's not that we are for or against stock market or stocks or equities, bonds. It doesn't matter, right? If you have a particular skill, if you're very skilled in transacting commodities or the stock market in any, that is a personal decision in how you want to invest. But if you take a step back, what we're talking about is the process of controlling capital, which came up multiple times in your conversation throughout your lifetime. And there is something very important, again, to recognize when separating capital control, capitalization, and investing. And the reason is this. Regardless of the volatility of this curve, forget about it, right? The focus in the traditional financial conversation with a personal financial planner or whoever it is that you work with is going to be about the accumulation over time until you get to a point in life where you don't want to have any more productivity, and then you're going to use those funds to pay for the expenses of your life. No different than when we compounded capital, and then when it got to the moment of spending it in a liability or an asset, you're going to interrupt that compounding and you're going to drive it to zero. There's a similarity in that process to the fallacy or the issue that we were presenting as the problem before. You finance everything in life, right? And to me, personally, this also comes down to the conversation about legacy. I want my productive life not just to serve me and my needs in the future, but I want it to be a springboard for others to stand upon and advance the function for the next generation to come. I want there to be compounding beyond my lifetime.
Absolutely.
And this will interrupt that. So this is a process that I had to question. I was engaged in this. This is what I did when I started my first job, how I manage money, and until I stood back and I learned, okay, is there an alternative? What if we actually take the best parts of this, the focus on compounding, but instead of interrupting it, we found a focus on cash flow, and we continue that growth over time, so it gets better and better and better, so there's more abundance for the family, for the business, more stability.
Right.
This is something that applies to monthly, quarterly performance on a business from a payroll perspective. Like if you constantly accumulate capital and it drains, it's very difficult to support the compounding we're talking about. So think about that. How is money moving through your family, through your life, through your business? Capitalization is a very different process that needs to be understood, that requires processes and platforms to execute on, that is different to the core competency of your business, that is different from earning money, that is different from investing and deploying that capital. So I hope this has been pretty helpful. Any other comments you have, any other thoughts about this, Josh?
Just again to reiterate, we aren't trying to bag on anybody. We're not here to tell you you're doing everything wrong.
No.
These are insights that we have gained, issues that we see, especially in America's middle class, that we want to bring to light, challenge your way of thinking, challenge everything you've been taught to see how are others doing it better.
Yeah.
And that's truly our focus. We don't want to come up here on a pedestal and try to bash people. It's let us help you learn more about how to take control of your finances, how to take control of your future, and hopefully the future of your loved ones or any charities that you want to leave, trust funds to, things like that. Like this essentially became an intro guide to financing life and estate planning, and we're going to jump much deeper into that.
For sure.
And I just hope that it is a way to get you to start thinking more about how you're treating money and that relationship with money.
For sure, for sure. We're men in the arena. We're not saying we know it all. We are engaged in this process, learning, growing, building every day. We want to share that journey. We want to share what we see the most successful entities and people around the country doing, banks in particular. And I think that it should be brought to the you and me level because it's going to be a source of growth, understanding, more prosperity. So hopefully you enjoy the conversation. Whether you agree with us or not, it's not the point. What matters is that it makes you think, and you either are going to confirm that what you're doing is exactly right for you, or maybe it's going to open the seed for opportunity on how to make things better from what you're already doing. We'll be next with another episode, and we look forward to the next conversation. Thank you, Josh.
Thank you.